Hello everyone, welcome to EduTap and welcome to the Finance 360-degree sessions in which we are going to cover the relevant and important finance current affairs, the RBI notifications and the RBI press releases. Okay, and in today's session I have brought a very important RBI notification for you, that is regarding the forward contracts in government securities. So the directions has been released by the Reserve Bank of India for the forward contract in the government securities. Now do inform me if I am clearly audible and visible. Like, do inform me if everything is fine. Okay. So we are going to discuss the directions in regards to the forward contracts in government securities. So the Reserve Bank of India has released the directions for the forward contracts in government securities that we are going to discuss in today's session, and this is going to be a very important session. This is going to be a very important topic for all of you, as the forward contracts, this is for the first time that the RBI has released such directions. Okay, so let's discuss this, and before starting with this topic, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, so in the Telegram channel you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So let's get started with the topic at hand today, and today we are going to discuss the directions that have been released by the Reserve Bank of India, that is called the Reserve Bank of India Forward Contracts in Government Securities Directions 2025. Okay, so starting with this, first of all, what are bond forwards or what are the forward contracts in government securities? So first of all, it has been described by the RBI that the forward contracts in government securities will be called bond forward. So what are the bond forward? They are the rupee interest rate derivative contract in which one counterparty, that is the buyer, is agreeing to buy a specified government security from another counterparty, that is the seller, on a specified future date at a predetermined price. Okay, so now let's take an example, and through that let's try to understand that what is this whole bond forward all about. Okay, so bond forward, first of all, how many of you know about the derivatives? The derivatives, they are the financial contracts, they are the financial instruments that derive their value from an underlying asset, Now this underlying asset can be anything. It can be a bond, it can be a stock, it can be gold, it can be any physical commodity also. So the derivatives, they derive their value from an underlying asset. That can be any foreign currency, that can be any product also. Okay, now bond forwards. Now derivatives have four kinds. There are four kinds of derivatives, that is the futures, forwards, swaps and options. So futures, they are sold and bought at the exchanges, in the stock market, we can say in the exchanges, they are being bought and sold, the futures. But the forwards, they are being bought and sold in the over the counter market. That means the forwards, they are being bought and sold not in the exchanges, they are being bought and sold in over the counter markets, that is through the electronic trading platforms and such, that we are going to discuss. But first of all, what is this bond forward? What is this bond forward? Okay, so bond forward is basically a financial contract where it has been written that this there is a government security, let's say a 5-year government security, that will be bought at a bond price, at a price of 1,000 rupees on the specified date, that is 25th October. Let's say this is the contract that has been signed, that this particular government security will be bought at a bond price of, at a price of 1,000 rupees on 25th October. So this is the bond forward where there is the seller that has agreed to sell the government security at the bond price of 1,000 rupees on 25th October, and there is a buyer that has agreed to buy this government security on the specified date. So there is a specified future date, 25th October 2025. So that is a future date. That is just the example that we have taken, but there is a specified future date and at a price determined at the time of the contract. So the bond price has been determined at the time of the contract. Now, how many of you know that the bond prices fluctuate with the interest rate, or the bond prices can change with the interest rate? Anyone has any idea regarding this? Any idea? So how many of you know that the bond prices, they actually change with the interest rate? So let's say that the interest rate is increasing in the economy. Now, if the interest rate is increasing in the economy, the yield for the bonds will increase. There will be a upward pressure towards the yield and the returns of the bonds. So to increase the yield of the bonds, to increase the returns of the bonds, the bond prices will decrease. So this is the relationship, this is the static relationship between the interest rate, yield and bond prices. If the interest rates are rising in the market, in the economy, the yield will rise for the bonds and the bond prices are going to decrease. So let's say now, right now it is March that is going on. So by May, June, July, by October, what happens that the interest rate starts rising in the economy and the bond prices starts falling. Now, the market price or the price of this bond on 25th October is 800, or let's say it is 900 or 800. So who will be benefiting here and who will be losing here? The seller will be benefiting or the buyer will be benefiting? Who will be benefiting? Now the bond price is 1000, that has been agreed by the buyers and sellers, and this has to be the settlement will happen on the 25th October, and on 25th October actually what happened that the bond price decreased, the market price of the bond decreased to 800 rupees. So here what happens that the market price has decreased to 800, but the seller who is selling, like who has already agreed to sell at 1000 rupees, so seller will be selling at 1000 rupees, while in the market he would only have got 800 rupees. So the seller is making the profit of 200 rupees, that is the seller is making a gain of 200 rupees. Now the buyer, if the buyer would not have agreed, if the buyer would not have signed this contract, the buyer would have been able to purchase the bond in the market on 25th October for 800 rupees. But the buyer has already agreed. So the buyer will be making a loss of 200 rupees because the buyer will have to pay 1000 rupees, that is the bond price that was agreed. So I hope this is clear. This is the idea that is very much clear. So this is a bond forward. This is the bond forward on which there is a future date on which the trade will happen. And here the bond forward is known as, they are known as rupee interest rate derivative contract, because the bond prices, they depend upon the interest rate. If the interest rate is increasing, bond prices will decrease. If the interest rate is decreasing, bond prices will increase. So this is how the sellers and the buyers, they can benefit or they can lose because of the fluctuation in the interest rate. That's why the bond forward, they are the rupee interest rate derivative contract, where the value of the derivative, where the value of the bond forward depends upon the interest rate. Any confusion here? So this was the contract that would have been settled on, or that would settle on 25th October. The bond price for the government security for the bond is decided at 1000 rupees. That will be settled on 25th October. The seller has agreed to it, the buyer has agreed to it. Now on 25th October 2025, actually the market price for the bond is 800 rupees because the interest rate have increased. So the bond prices have decreased and the bond prices are 800 rupees. So here the seller will be winning, or if the seller will be on the gaining position, because the seller is getting 1000 rupees while in the market the bond is only 800 rupees. Okay, and the buyer is the losing party because the buyer has to pay 1000 rupees while the bond now is only of 800 rupees. Okay, so this is the whole idea. Now moving forward, I have told you that the bond forwards or the forward contracts, they are sold not on the exchanges, but they are sold on the over the counter market, or they are sold on over the counter, including the electronic trading platforms. Okay, so electronic trading platform, they shall mean any electronic system other than a recognized stock exchange. Okay, so bond forwards, they are sold in over the counter markets, they are sold over the counter, they are not sold in the recognized stock exchange. Okay, so electronic trading platforms shall mean any electronic system other than a recognized stock exchange on which the transactions ineligible instrument is happening. So eligible instruments are the securities, money market instrument, derivatives and such. So there are different electronic trading platforms that are other than the recognized stock exchange, where the bond forwards or the forward contracts can be sold and bought. Okay, so future contracts, they are sold in the, or they are bought in the recognized stock exchange. So the futures, they are under the recognized stock exchange, but the forwards, they are traded on the over the counter market. Now, who are the eligible market participants that can undertake the forward contracts in the government securities? So, eligible market participants, the following persons shall be eligible to undertake the bond forward transactions in the government securities. That is a resident of India and a non-resident who is eligible to invest in government securities. So, there are some non-residents that are eligible to invest in government securities. So, they should be allowed also to undertake bond forward transactions. Now, market makers. Have you ever heard the term market makers when you were studying about the government securities? So, I hope and I think that when you were studying the government securities, you must have heard the term market makers or the primary dealers. Okay, so usually the market makers are they are also called primary dealers, because usually the primary dealers are the market makers. So market makers, they maintain the liquidity in the government securities. Okay, so market makers, they are financial institutions or entities that provide liquidity by continuously quoting the buy and sell prices and by continuously buying and selling the bond forward contracts or the government securities in the government security market. Okay, they facilitate trading, ensuring smooth market operations. So who can be the market makers, or who are the market makers in the bond forward contracts for the government securities? The following entities shall be eligible to undertake transactions in the bond forwards as market makers. So scheduled commercial bank except small finance bank, payment bank, local area bank and regional rural bank. So remember that the scheduled commercial banks except these are eligible to become market makers in the bond forward contracts, as well as the standalone primary dealers. They are also eligible to become market makers in the bond forward contracts for the government security. Next point about the market maker is that market maker may undertake long position. Long position means the buyer of the bond forward contract takes a long position because they are buying the bond. They are going to buy the bond in the future. Okay, so they are taking a long position, that they are deciding that on 25th October I will buy this 5-year government security. So they are taking the long position. So the buyers, they agree to buy the bond at a future date at a determined price. So they are taking the long position, whoever is agreeing to buy the bond in the future date in the forward contract. Okay, now the market maker, they may undertake long positions without any limit. So they can buy the they can buy the forward contracts without any limit, as well as they can take the covered short position in bond forwards. So short position means that here there is the sale that is happening of the government securities through the forward contract, that the market maker is agreeing to sell the government security on a future date through the forward contract. So short position is the sale position, we can say. Now here covered short position means that this is a position in bond forward in which the seller of the forward contract holds an equivalent amount of government securities underlying the position. That means if I am saying that okay, on 25th October I will sell the government security. So in March I already have that government security with me. It's not like that I'm considering that on July I will purchase it and then I will sell it in October. Or let's say I will purchase the government security on 23rd October and I will sell it on 25th October to make a short-term profit, we can say. So it is not like that. The covered short position means that when the contract is being signed between the buyer and seller of the forward contract, the seller already has the equivalent amount of government security underlying the position. That's why it is a covered short position, that is the sale is already covered by the seller. Okay, so covered short position means in bond forward in which the seller of the forward contract hold an equivalent amount of government security underlying the position covering the short position. Okay, so I hope this is very much clear. So a market maker can undertake long positions without any limit, they can buy the forward contracts without any limit, and they can also undertake covered short position in the bond forward without any such limit. Now, the next point is that a market maker that is allowed to undertake short sales as per the directions that were released by the Reserve Bank of India in 2018. So there are certain entities that are allowed to undertake the short sales. So which are these entities? So it is the scheduled commercial banks, primary dealers, urban cooperative banks, which are financially sound and well managed, that have some that are following some criterias. Okay. Any other regulated entity which has the approval of the concerned regulator like the SEBI, IRDI and such. Okay, so these are the eligible entities that can undertake the short sales. Short sale actually means that you are agreeing to sell a bond or you are agreeing to sell a security, but you do not have the security right now. So that is actually a short sale, that you do not have the security right now, but you are agreeing to sell it on a particular date because you think that you are going to buy it in the future and you will sell it on the particular date. Okay, let's say today is 8th Feb and you have agreed to sell the security on 10th Feb because you are expecting that by 9th Feb the security prices are going to go down. So then you will purchase at the lower price and you will sell at the higher price. Okay, so this is a kind of short sale where you actually do not have the security right now, but you are promising to sell it to the buyer. Okay, so this is the idea of the short sale. But here it was said that the market makers, they can sell the covered short position, or they can sell the forward contracts, or they can undertake the covered short position where they already have the equivalent amount of government security. So that is a covered short position, okay, where the seller already has the equivalent amount of government security and the seller is not waiting to get it in the future date. Okay, now here the short sales, it is said that only these entities can do the short sale. So a market maker that is permitted to undertake the short sales in terms of short sale directions 2018 as amended from time to time, they shall also be eligible to undertake uncovered short positions. So uncovered short position means that at this point of time you actually do not have the government security, the equivalent government security. Okay, subject to the underlying government security being eligible for short sale. So only a few of the government securities, they are allowed for the uncovered short position, and such uncovered short positions should be reckoned. So if there is uncovered short positions that are being taken, so that will be considered under the limits. So the uncovered short position will come, the uncovered short positions, the uncovered short position in the government securities in the bond forward will come under this limit. Okay, so basically the long positions, the long position will have no limit, the covered short position will have no such limit. But when we are talking about uncovered short position, that means you want to sell the bond in the future date through the forward contract, but actually it is not covered by you, it is not available with you. So uncovered short position, the market makers, these particular market makers, they are allowed to take the uncovered short position in the specified government securities under the limits, under the overall limits of this. Okay, so such uncovered short positions shall be reckoned in the security level limits on short sale and cannot remain uncovered for more than 3 months. Okay, so they cannot remain uncovered for a period exceeding the maximum period, that is usually the 3 months. Okay, so they cannot remain uncovered for long. So this is the whole idea. Any confusion in this? Because this was the toughest part of the whole notification or direction, we can say. Okay, so short sales actually in our country, naked, I don't know how many of you remember, but last year the directions were released that in our country the naked short sales will not be allowed. Naked short sales means that you have agreed to sell, okay, but you have no arrangement of having the security. You have not borrowed the security, you have not made any arrangement to get the security, and you are just promising to sell on a particular future date. Let's say on 10th Feb, you are promising to sell this security without having any borrowing, without having any measures to get the security. Okay, so that is naked short sale. That is, you do not have any means to get the security, but you have promised to sell it. How? When you do not have it, okay, and you do not have any measure to have it. So it was said that only the short sales that will be allowed, only that short short sales that will be allowed, where you have borrowed the security or you have like the means to borrow the security, then you can promise to sell it to a person on a specified date. Okay, so at least you should have a measure to like to have the security with yourself. Okay, so this was the idea. So here also the same thing is being said, that covered short position, there is no problem in the covered short position, because if you are selling the security and you already have the coverage, you already have the equivalent amount of government security, that means you can easily sell the security, you already have it to sell it. Now, uncovered short positions, so there are some directions, there are some limitations on the uncovered short positions. If you are trying to sell it and you do not have the security, the equivalent amount of government security, maybe you have a lesser amount of government security and such. So in that case, there are some limitations that are there. Now, any confusion, anyone? Should I move forward? Say yes or no, then only I will be able to move forward, or if there is any confusion, kindly ask me. Clear? Okay, nice. Thank you. At least one of the parties of a bond forward transaction shall be a market maker or a central counterparty that is authorized by the Reserve Bank of India for the purpose of the bond forward contract in the government securities. Okay. In the naked short selling, see, uncovered short position, here it is not like that you do not have any measure. Maybe you see, uncovered short position is any position that is other than the covered short position. So in the covered short position, you have the equivalent amount of government security. In the uncovered short position, it can happen that you have the government security but not of the equivalent amount. It can happen that you have the means to borrow the government security but you do not have it right now. So uncovered short position is not as bad as naked short selling. In the naked short selling, there is no means of having it at all right now. You are just like assuming that the prices will go down, then you will buy, then you will complete your promise. So in naked short selling is completely like blindly you are going in the market. But in the uncovered, there are like maybe you have less than equivalent amount of government security, you have the government security but of a lesser amount, or let's say you have the means to borrow it, you have the means to get it. Okay, so that is, so there is a minor difference between the two. Naked short selling is the worst kind of short selling that can create problems in the market, because the sellers, they are just assuming that the prices will go down, then they will purchase and by the next day they will sell it, but that actually do not happen, right? So at least one of the parties of the bond forward contract shall be a market maker or a central counterparty authorized by the Reserve Bank for the purpose. Now users, we have discussed about market makers, so one of the party will be market makers. Both the parties can also be market makers, but let's say one party is market maker, so the other party will be some user. So who are these users? So users means a person that undertakes the transactions in bond forward contract other than as a market maker. So users are the second party. So if one party is market maker, the second party are the users, we can say. So any entity that is eligible to be classified as a non-retail user in terms of the rupee interest rate derivatives direction 2019, so they are eligible to undertake transactions in bond forward as a user. So any entity that is eligible to classified as a non-retail user as per the 2019 directions, so they can undertake the transactions in the bond forwards as a user. Okay, so this is the idea. Now non-retail users, so as per the 2019 directions, I went to the 2019 directions and this was the criteria for the non-retail users. So non-retail users shall include entities regulated by the Reserve Bank of India, so that means NBFCs and the banks and such, insurance companies that are under the IRDI, the mutual funds, pension funds and other collective investments vehicles, all India financial institutions, that is 5 all India financial institutions, NABARD, NAFID, NHB, Exim Bank and SEBI. So these are the 5 all India financial institutions. Okay. Next is your companies, entities with net worth of 500 crore or above and non-residents other than individuals. Okay. So these are the non-retail users that are allowed for undertaking the transactions in bond forwards as a user. Now directions for the users. There are certain directions for the users and here you can see that specifically uncovered short selling is not allowed or uncovered short position is not mentioned at all in the directions. So that means in the directions for the users, it has been specified that an eligible resident user may undertake long positions in bond forward. That means you can buy the contract, you can buy the government securities at a future date. That is absolutely fine because you are buying it, okay, without any limit. So they can take the long position without any limit. All eligible user, resident and non-resident, may undertake covered short position in bond forwards only for the purpose of hedging. That means it's not like that you are taking the covered short position, you are trying to sell the government security for the purpose of speculation, because that will make the government securities market very volatile. So if you are trying to sell the government securities and you have a covered position, that means you have equivalent amount of government security, then in this case the short position that you are taking, the covered short position that you are taking, should be for the purpose of hedging, that is for reducing your risk, okay. To ensure that short positions undertaken by a user is covered, so if a user is undertaking the short position, it should be covered. It should be covered, and this should be checked by the market makers. They may call for any relevant information, documents from the user, who in turn shall be obliged to provide such information. So it is very specifically said that the users, they can only take the covered short position, okay. So a user with a covered short position in a bond forward shall exit its short position in case it ceases to hold the underlying government security. That is, as soon as, let's say the bond forward, this bond forward, it is for the date of 25th October. Now you signed this contract on 12th March. Now at this time, let's say I am a user, or let's say XYZ, that is the insurance company, is a user. Now they have agreed to sell the government security, the particular government security, at a particular price. Now they because they are the insurance company, they are not the market maker, so they are the user, right? Now they are allowed to sell the government security and to come in this bond forward in the government security, because they have the covered, like they have the covered short position, because the sale that they want to do, they have the equivalent amount of government security. But now let's say that by April or by June, July, what happens, that the insurance company is in the need of the money and they sell the government security. That means now their bond forward is not covered. Now they do not have the equivalent amount of government security. So as soon as a user with a covered short position in a bond forward, they shall exit a short position. That means they will have to cancel the bond, or they will have to transfer the bond to some other seller if in case they have stopped to hold the underlying government security, the equivalent government security, okay. So that means the users, for market makers, because they are the big market makers, they are the big entities, they were allowed to take the uncovered short position, but that in that also there was the limits that were there. But for the users, no uncovered short position. As soon as you do not have the equivalent amount of government security, exit your position at the same point of time, okay. So this is the direction for the users. Now settlement, how the settlement will happen. So a bond forward transaction may be physically settled or cash settled, okay. So what is the meaning of cash settlement? So let's take the first example. So in this example, let's say that the buyer is having the loss of 200, or let's take an example. Okay. So let's say this is the bond forward, and here you are selling a government security, or you are promising to sell a government security at a bond price of 1000 rupees, and this will be sold, or this will be settled. This transaction will be settled on 25th October, okay. Now the market price on 25th October is, let's say, 1200. So who is the who is winning here, who is gaining here, who is losing here? Anyone? So the bond price as per the contract is 1000 rupees. So the buyer will be able to get this bond at the 1000 rupees on 25th October, but the market price is 1200. So here the buyer is gaining, because rather than paying the market price, rather than paying 1200 rupees, the buyer only has to pay 1000 rupees. So immediately he is making the profit of 200 rupees, and seller is losing here, okay, because seller could have sold the bond for 1200 rupees, but the seller is only able to sell the bond for 1000 rupees. So here see, the whole in the cash settlement, so try to understand that in the cash settlement, the bond is not getting settled and the whole amount is also not getting transferred. Only the difference amount is getting transferred. So let's say the buyer is making the gain of 200. So 200 rupees will be sent from seller's account to buyer's account. That's it. Okay. So seller do not have to give the government security. Only the difference amount has to be settled. So this is the idea. Okay. So cash settlement in a bond forward means that instead of delivering the actual bond at settlement, the counterparties, that is the buyer and seller, they exchange the cash difference. They exchange the cash difference between the contract price and the market price. So let's say contract price, that is the bond price in the contract, was 1000 rupees, while the market price is 1200 rupees. So 200 rupees has to be transferred from the seller to the buyer. Okay. So this is the basic idea. In the physical settlement, actually the bond gets transferred and the whole the bond gets transferred and the money also gets transferred. So that is physical settlement of a bond forward. This means a settlement process in which the seller transfers the underlying government security to the buyer and the buyer is giving the money to the seller. Okay. So this is the idea. So a physically settled bond forward transaction shall be settled through the Clearing Corporation of India Limited. Remember this, that through which it should be settled through the Clearing Corporation of India Limited or any other clearing agency or clearing arrangement approved by the Reserve Bank of India. Okay. Next, a cash settled bond forward transaction may be settled bilaterally in each other's account. They can like settle, let's say 200 rupees has to be sent from the seller to the buyer, so they can settle it bilaterally or through any clearing arrangement approved by the Reserve Bank of India for the same purpose. Okay. Now let's say that in July I recognized or I realized that I will not be able to sell the bond in October. So I can unwind my position. That means I can leave my position. So let's say I am the seller and I recognize that I will not be able to sell the government security on 25th October. In June or July, I recognize this. Okay. So market participant may exit its position in a bond forward by unwinding, by leaving the position with the original counterparty with the permission of the original counterparty, or they can assign their position to some other entity, or they can assign the position to any other eligible market participant through the novation process. So novation is the replacement of a contract between two counterparties. Let's say between the let's say the transaction or the agreement has happened between A and B. Now the B is saying that I cannot fulfill my commitment because I do not have the bond now, I do not have this and that. So B will leave its position and this position will be sold or this position will be transferred to C. So now a new contract will be formed between A and C. Okay. So A do not have to do anything. The contract just is being transferred from the B to C. So novation is the replacement of a contract between two counterparties to an OTC derivative transaction with a new contract between the remaining party and a third party, that is the new party. So this is the novation process. So if you are exiting your position, you are unwinding your position, so either take the permission from the original counterparty or transfer the contract to a third party. Okay. Now the settlement basis, should the transactions like in which government security the physical settlement will be allowed, in which government securities the cash settlement will be allowed. So what will be the settlement basis? The cash settlement, physical settlement, for which government securities, for which forward contracts there will be cash settlement, for which there will be physical settlement, and what will be the market conventions, what will be the rules and regulations in the market for the bond forward transactions. This shall be specified by the Fixed Income Money Market and Derivatives Association of India in consultation with the market participants. So we have discussed the overall rules and regulations that have been specified by the RBI. But for the working of the market, there are more rules that has to be identified and the market conventions has to be identified. That will be done by the FIMMTA. Okay. So the standard conventions or the standard documentation procedures will be prescribed by this organization. So that is the idea. What do you want me to explain? Novation. So see, in the novation now what happens, let's say that you want to leave your position. Okay, you want to exit your position. So either exit it with the permission of the other counterparty, with the permission of the other party, you can exit your position, or you are transferring your position to some other entity. Okay, so novation is the replacement of a contract between the two counterparties. Let's say Aditya and me. So we are the two counterparties. Okay, so there is the transaction that is happening between Aditya and Kritika. Now I am saying that I will not be able to fulfill the commitment because let's say I do not have the money, or I was expecting to get the money but I didn't get the money. So I am saying that I will not be able to buy the bond. Okay, so either I can take the permission from Aditya and I can leave my position. So that is the unwinding of the position, and I am exiting my position with the permission of the other counterparty. But let's say Aditya needs the bond on the specified date. So Aditya will say that no, I cannot leave my position, I cannot allow you to exit. So Kritika will find another another buyer. Let's say there is another buyer, Shrishti. So I will find another buyer, so that will connect with Aditya. Okay, the contract will be transferred. Before, the contract was in between Aditya and Kritika. Now the contract will be in between Aditya and Srishti, the same contract. Okay, so that is the novation process. So novation is the replacement of a contract between the two counterparties to an OTC derivative transaction, with a new contract being the now the new contract will be between the remaining party and the new third party. Okay, so this is the idea. Okay, now this is the last slide. So the market timing for undertaking the bond forward transaction shall be the market timing specified by the Reserve Bank for undertaking the OTC rupee interest rate derivative transaction, because the bond forwards in the government security, this is also a type of rupee interest rate derivative contract. Okay, now how the reporting will happen? So just the basic idea you require, that a market maker shall report all the bond forward transactions undertaken during the day to the trade repository of the CCIL. So I hope you remember that the OTC transactions have to be reported to the trade repository of the CCIL. So this you have to remember before the closure of the trade repository for the day. So the reporting shall include the details of the counterparties, that who are the counterparties. There is a bank and insurance company, there is a bank and mutual fund, there is a bank or NBFC and the pension fund, one market maker, one user, or both the market makers are there. So details of the counterparties, the underlying government security, the settlement type, that is it is being cash settled or physically settled, and whether a short position is covered or uncovered short position. So all the details have to be identified and all the details have to be specified in the trade repository. Market makers shall also report instances of unwinding if there is unwinding that is happening by a particular counterparty. Novation, that novation has happened and the contract has been transferred to some other entity. Bilateral settlement and settlement default to the trade repository. So all this reporting has to happen. Okay, for trade involving users which will be settled through CCIL, the user of or the market maker or clearing member of the CCIL through which the user is availing the CCIL's clearing and settlement services, they shall report, like any of these entities can report the transaction, all the bond forward transactions undertaken during the trade. Okay, so these are just the reporting criteria that you can read. Now violation or violation of directions. Let's say any one entity has violated the directions of the Reserve Bank of India. They have they had the covered short position, but let's say now they sold their government security and they didn't tell it to the trade repository and such. So they are continuing with their uncovered short position under the gauge or under the garment that they have the covered short position. So that is wrong, because if you have the covered short position and let's say you are selling your government security, then you are coming in the category of uncovered. So you have to tell it. Okay, so if this is not happening, then that is the violation of the direction, right? So in this case, the Reserve Bank of India disallow that person or agency from dealing in bond forwards for a period not exceeding 1 month at a time, after providing reasonable opportunity of hearing. Such action may be made public by the Reserve Bank of India. Okay, so if violation of is happening of a direction, then for a period not exceeding 1 month, the person will be kicked out from the bond forward market, and after providing reasonable opportunity of hearing the person. So this is the idea. Now any confusion anyone has? So before going to the MCQs, so let me show you. If you go to edutap.in, So if you go to edutap.in, you can go to EduTap's website, and here you can see the free material. In the blog section, you are getting the free material, you are getting the exam information, you are getting the strategy, the courses, and the success stories, that if you want to know about a particular exam, you are getting the information about that exam. Okay, let's say you want to know about RBI Grade B, or you want to know about NABARD Grade A, so you can get the exam information, strategy, success stories in the free form, okay, in the blog format. As well as, let's say you want to see the courses. Okay, if you want to see the courses, you can see the courses that is provided for the different examination. Let's say you want to see that what courses are there for RBI Grade B, and so you can see the courses, and you can see that in the course, in let's say in the gold course, what all you will be getting. So what is the off that is going on, what all you are getting in the gold course for the phase 1, for the phase 2, for the interview, and who all will be teaching. So everything is given here. So before buying any course, you can see the details here in the courses section in the edutap.in, that is EduTap's website. So this is the first question. Unwinding means leaving a contract. Okay, so you are unwinding your position, that means you are leaving your contract, or you are leaving your position. Okay, so RBI has released the directions, and you have to tell. So now here you have to tell that which of the following entities are eligible to become market makers. So this question is particularly in the context of market makers. So do remember that the exception is there, that these entities cannot become market makers. So remember that. Okay. Next question is regarding that which of the following are eligible to undertake transactions in bond forwards as a user. So in the category of as a user, there are certain criterias that I have shown you. So remember that criterias. Okay. So these are the two questions. I hope you will be able to answer both the homework questions, and see you in the next session. So do give the right answer of the homework question. Okay. So this is it. Thank you everyone. Thank you for joining. I hope you enjoyed the session, and now we will meet in the next session. Do give the right answer of the homework question. Okay. And if there is any confusion, any query,